Exploring liquidity risk appetite, understanding risk tolerance in financial management. Presentation agenda. Definition of liquidity risk appetite. Liquidity risk appetite defines the level of risk an organization is willing to accept. Understanding this is crucial for effective risk management. Factors influencing liquidity risk. Several factors can influence liquidity risk, including market conditions and organizational policies. Identifying these factors is essential. Techniques for assessment. Various techniques can be employed to assess liquidity risk, including stress testing and scenario analysis. These techniques provide insights into potential risks. Management strategies. Effective management strategies are required to mitigate liquidity risks. These may include cash flow forecasting and diversification of funding sources. Understanding liquidity risk appetite. Definition of liquidity risk appetite. Liquidity risk appetite refers to the level of risk an organization is willing to accept. Understanding this concept is crucial for informed decision making. Importance for financial stability. A strong grasp of liquidity risk appetite helps organizations maintain financial health. It plays a key role in risk management and strategy. Defining liquidity risk appetite. Understanding liquidity risk appetite. Liquidity risk appetite defines the acceptable risk level for an organization. It guides decision making regarding asset liquidity. Balance of cash needs. Organizations must balance the need for cash with the risks associated with illiquid assets. Strategic planning is essential. Importance of liquidity risk appetite, aligning risk with goals. A clear liquidity risk appetite aligns risk taken with the organization's strategic objectives, enhancing overall performance. Supporting decision making. Effective liquidity risk appetite facilitates informed decision making during market fluctuations and uncertainty. Ensuring adequate liquidity. A well-defined appetite ensures that organizations maintain sufficient liquidity across varying market conditions. Factors influencing liquidity risk appetite. Market dynamics. Market fluctuations can significantly impact liquidity risk appetite. Organizations must stay informed and agile to adapt. Regulatory requirements. Compliance with regulations shapes liquidity risk management. Organizations must align strategies with legal obligations. Internal policies. An organization's internal policies dictate its approach to liquidity risk. These policies must be clear and comprehensive. Market conditions. Economic fluctuations impact. Economic changes can significantly alter a firm's liquidity needs and risk tolerance. Interest rates effects. Variations in interest rates influence borrowing costs and liquidity preferences. Investor sentiment. Shifts in investor confidence can lead to changes in liquidity risk appetite. Regulatory environment. Impact of regulations. Regulatory frameworks can significantly influence an organization's liquidity risk appetite. Compliance drives strategic decisions. Capital adequacy norms. Capital adequacy norms are crucial to maintaining liquidity. These norms ensure organizations have sufficient capital reserves. Conservative strategies. To ensure compliance, organizations often adopt more conservative strategies. This minimizes risk and protects assets. Assessment techniques. Quantitative techniques. Quantitative techniques use numerical data to evaluate liquidity risk. These methods provide measurable insights into risk levels. Qualitative techniques. Qualitative techniques focus on subjective factors and expert judgments. They help in understanding the context of liquidity risk. Risk appetite understanding. Understanding risk appetite is crucial for effective liquidity assessment. It guides decision-making processes in financial management. Quantitative measures. Understanding liquidity ratios. Liquidity ratios measure an organization's ability to meet short-term obligations. They are crucial for assessing financial stability. Importance of cash flow forecasts. Cash flow forecasts predict future cash movements, aiding in financial planning and risk management. They help organizations avoid cash shortages. Qualitative assessments. Evaluating internal policies. Assessing internal policies helps identify strengths and weaknesses in liquidity risk management. Stakeholder perceptions. Understanding stakeholder perceptions is crucial for effective risk appetite assessment. Management strategies. Evaluating management strategies aids in tailoring approaches to liquidity risk appetite. Management strategies. Understanding liquidity risk. Liquidity risk arises from the inability to meet short-term financial obligations. Organizations must assess these risks regularly, aligning with operational goals. Liquidity management should align with daily operations to ensure smooth functioning. This alignment minimizes disruptions. Strategic objectives focus. Organizations must ensure liquidity strategies support broader strategic objectives. This ensures long-term sustainability. Risk mitigation approaches. Maintain cash reserves. Maintaining cash reserves provides a buffer against unexpected financial challenges. It ensures liquidity during crisis. Contingency funding plans. Developing contingency funding plans prepares organizations for sudden financial needs. It enhances resilience against risks. Diversifying funding sources. Diversifying funding sources reduces reliance on a single income stream. It stabilizes finances in volatile markets. Stress testing and simulation. Understanding stress testing. Stress testing helps gauge financial stability under adverse market conditions. It is crucial for financial resilience. Role of simulation exercises. Simulation exercises model potential market changes and their impacts. They prepare organizations for various scenarios. Impact on liquidity positions. Assessing liquidity positions is vital for managing cash flow. Stress tests reveal vulnerabilities in capital availability. Informing risk appetite. Stress tests inform an organization's risk appetite by revealing capacity for risk in changing conditions. Conclusion. Importance of liquidity management. Understanding liquidity risk is crucial for maintaining financial stability and resilience. Balancing risk tolerance. A careful balance between risk appetite and operational needs is necessary for effective management. Thank you.